Good afternoon, everybody. Tom Gucci here with the Mortgage Collaborative, welcoming you into their latest TMC Connect broadcast, which is Clean Up with Clean Data, why data quality is key to transforming productivity and business elasticity in mortgage operations. We got a great discussion queued up for you today. Going to give it just a minute to allow folks to filter into today's conversation, and then we'll get started shortly. Just heads up in the meantime, if you have any questions or comments for the group throughout today's discussion, you can feel free to filter those through either, if you're on Zoom, either through the chat function or the Q&A icon, both of which should be located at the bottom of your screen. And we will look to address those in real time. And if, if we have to, just to do any time constraints, we can make sure to try to get any additional questions answered at the end of today's discussion. So on that note, we'll go ahead and get things kind of kicked off here. For today's discussion, got a great pair of industry leaders here leading today. We've got from our partners at True, the SVP of Product and Innovation, diehard Yankees fan, I'm assuming, Bob Noble. How you doing, Bob?
Great. How are you guys doing?
Doing excellent. And then also joining us today, longtime TMC member from Arvest Bank, the Executive Director of Sales, or Mortgage Sales and Development, Sean Carnes. How are we doing, Sean?
Good.
Good. Well, just to kind of level set as we dive into today's discussion for our audience, really what we're focused on is just digging into exploring how clean data is changing mortgage originations. And we're going to look to discuss some real-world examples of how lending intelligence produced by AI will transform our industry, not only from a productivity standpoint, but also towards driving business elasticity for lenders. So on that note, let's go ahead and jump right in. First question I've got for you, Bob, here would be, the mortgage industry has made significant investments in loan origination systems and other technologies with the goal of streamlining processes and reducing origination costs. Despite this, mortgage originations, as we've seen through, for example, MBA's latest quarterly report, remain really high and full of, manual and human intervention, with the cost of origination now exceeding $12,000 on average per loan. What's your thoughts as to why that still is the case?
That's a great question, right? So I've been doing this for a little bit, 30 years now, and I've learned one immutable fact, and that is data is king, and clean data is absolutely a requirement to talk about any kind of process improvement. So you can have really great technology, and that becomes your engine. But if you're not putting good fuel into it, you're never going to run efficiently. So when we look at and do analysis across the mortgage manufacturing process, not just originations, but even through servicing and mortgage insurance and QC and everything along the way, it's all driven by this simple fact that unless you have good, clean data, automation isn't possible. So what do you do in absence of reliable data is you have to put people to validate and check the checkers, and that's where you slow down your process. With reliable quality and good quantity of that data, you're able to really drive that automation. And so I think the plain, simple answer is you need data, you need lots of it, and it has to be reliable, trustworthy, and clean.
Great points. Sean, yeah. What's your thoughts on that question?
Yeah, I would jump in. I think we make a big cost, but this is still a human business, and our business has changed so much. So I think a lot of technology and advancements have happened over the last few years, but you think about every company was so busy, even though we were getting new technology, we had so much business and able to implement and train. I think now is a time of training, teaching folks how to utilize the technology, from the loan officers, trying to, with day one certainty and other things, teaching them how to utilize that. They're so busy to ask for a pay stub or a W-2, but hey, let's see if we can use some of these other resources where we don't have to validate that information. And so I think we're so much still teaching folks how to utilize technology that we've spent years bringing on the technology and the technology getting to where it needs to be. Now it's up to us to make sure that we're teaching folks how to utilize that technology and finding experts that aren't just us and the trainers, but showing success from other folks of how they're using it. And I think that's what's held us. That's what's held us back, but it's also what's going to help us moving forward is just the continued training. Things are moving so fast, and there's that great book, Who Moved My Cheese, and we just got to keep between processors, underwriters, our loan officers. We talk about servicing, different things like that. We've got to continue to, as an old boss told me, wash, rinse, and repeat communication.
Yeah. Yeah, I think that, to add to that, and this is true about AI, but any technology, the change management aspects of that are really important. So, training is very important, but the trust in the results is really critical, right? If you have all this wonderful technology, and you don't trust the output of that technology, you're not going to let go and allow for automation to occur. So training is important, and trust it has to go kind of hand in hand with that, right?
And absolutely spot on. And Sean, you mentioned it in your remarks, and have seen this, largely within our network too, where, 2020, 2021, it's just a continuous flow of volume, and your entire organization's focus is getting every potential application in the door and closed out the door. And, definitely see that focus shift as volumes have slowed, looking back at doing more due diligence on the retention of existing technology solutions, and maybe a more deep dive vetting into new technology solutions, and pairing that with the opportunity to better train the operations, production teams on some potential efficiency gains in the loan process, and that can reduce turn times, and at the same point, maybe reduce some unnecessary spend through, different components of the loan process that, could be revised through the training. Yeah. And then beyond that too, I just answered the question. I think we've seen the focus change so much year over year to like the latest shiny object out there from a technology solution standpoint. Years ago it was business intelligence platform, then it became digital point of sale and ingesting property data, lead gen resources, market automation, bots, RPA, automated underwriting, you name it. That the focus tends to be out the shiny object out there, and maybe not past implementation, how you actually have these solutions work together in a process flow, as opposed to, having individual solutions that are great on their own right, but don't necessarily talk to one another or create a free flow of data exchange throughout the loan process. And I think that's what brings in more human intervention required, just due to that, and then a low confidence in the existing data or automated processes to, ensure quality.
One thing I'd like to add, you've got to track too. You bring on technology, and I think it's important for everyone to look at their tech stack. What is it, and constantly going back and reviewing it. What is my acceptance rate? What am I seeing, and am I tracking that? And I'm looking at that data. I think so many times in operations, we look how many files do we close, how many days, before it closes are in sales, what's closing, locks, and stuff like that. But we forget to look at, are we really looking at the adoption of the technology? And are we seeing where we have those that are accepting the technology and those where we have issues? And are we focusing on that? Or are we just still focusing on, well, the business, who's going to get this? How do we get faster here? But actually utilizing the data that's provided in a lot of the whatever system that you're using that shows you the adoption rate, and then how do you train, and how do you get folks mentored up with those that have embraced the technology and using those as examples. So I think we're in an environment now where it's important to look at your tech stack. Is it designed? Do you have a good plan with what you want, because it's not one piece.
Mm-hmm.
There's so many pieces of technology that we're using today. Is it coordinated, and have I communicated that well to all those folks that are using that? And then who's using it well, and how are we recommunicating that out to the rest of our teams?
Spot on.
Yeah.
And I think a good lead into next question I had here, and I'll direct it to you, Sean, at first. With so much human effort directed at document to data extraction and verification, is fixing the problem of data quality necessarily the best way for the mortgage industry to transform productivity?
That's a great question. And yes, I mean, the more that we can utilize technology, and being able to utilize, where I'm not so dependent on, this one pay stub or this, where we can start looking at some of that technology where the W-2s, or I'm pulling information from the IRS and I can see this, or what Fannie and Freddie, where they can look at the pay stubs, we're looking at rental history. I think it's important for us, but it's also important for these agencies to continue on the path that they're doing, so that we aren't constantly having to have to check the checkers, that we're utilizing, that it's not just mortgage, not just the companies utilizing the technologies, but also, whether it's Fannie, it's Freddie, or FHA, utilizing technology so that it's not coming back on us. There's probably many folks on here that have had buybacks, or 1% off. We calculated, the underwriter had 41%, and they're coming back and saying, well, we calculate the income and it's 42, and we want you to take this loan back, or something like that. I think the more that we can utilize that, and it's imperative for all of us to embrace that technology, and then that way we can have more confident customers and cut down on the expense of the process that the customer is paying. Because at the end of the day, it's not about us. It's about helping the consumer get into that house or refinance that house.
Mm-hmm. Right. That's a great point. I think the way I always look at this is, there's, and then I'll talk about the entire lending process for a second, right? There's data trapped within these documents. There's data trapped within other areas, and there's a real operational efficiency to be able to automate that with a high level of confidence, right? And so, technology allows for that, unlocking that data, gives you a level of scalability that really is hard to achieve through just humans, right? As we learned during the big boom, it was really hard to board resources to know how to process loans and do some of the data entry parts of it. It became really difficult to offshore during COVID, and we're seeing that expenses rise in that area as well. And the reality is humans make mistakes, and usually at a higher rate than machines. So when you look at the entire process, part of it being art, part of it being science, I think the science part is really where you want to focus automation, right? And not only capturing more data and understanding that you're going to get these wonderful operational efficiencies and scalability and so forth and so on. But it really speaks to the quality of the data, how you're able to really pull it apart and then check it through multiple different avenues, and to really have confidence that you're extracting and collecting data in an efficient way that's accurate, right? And so that cost of quality, it's a real no kidding equation. If you catch, it makes common sense, right? If you catch these mistakes with machines early on in front of the process, you'll save a lot of money. If you're fixing it, if an underwriter is fixing this problem, if you're fixing it at the closing table, if you're fixing it after it closes, if it's a defect when you sold the loan that you have to repurchase, those errors become really expensive. So the thought here is by unlocking the data, not only from the documents, from third-party sources, wherever, but being able to look holistically across the whole loan package, continuously validating that the data is consistent from document to underwriting system, that proper documents have been executed, that the necessary documents are there for the investor, that everything ticks and ties, that the right version of the DU findings were used, at the right or versions of whatever have been used, to do that programmatically so that you can get a high level of confidence, not only in your underwrite, but when you move it off to an investor, to get it to that investor quicker and have a higher level of confidence that's not going to come back to you with some defects that have to be rectified, and the worst case of all, a repurchase. So I think that's where automation really comes into play, is being able to do that process quickly, very effectively, very thoroughly. And then the areas where you need a human to intervene, looking for compensating factors on the loan, evaluating pictures and things like that, you focus their efforts on that art part. So now your whole process is streamlined. And that, of course, gets loans done quicker at less cost, helps the consumer, gets loans off your warehouse line quicker, gives lenders more capital to start getting more loans for customers, to get them in houses quicker. And it's just this like pinwheel effect of benefit. But it all really has to start with being able to unlock as much data as you can in a trusted manner, and being able to validate, so that the next step of the mortgage, the lending process you go to, you guarantee that, hey, we've cleaned this up, it's ready to roll. So your underwriters are focused on underwriting, not making sure that the loan amounts and the stated income matches the calculated income, and all that we can do with machines. And I think that's where you really want to focus machines at. And to your point, Sean, it has to be transparent, it has to be explainable, and it has to be reportable, right? Those, you have to have the trust, and you have to be able to show that trust, so that you don't want to, the worst thing in the world is to automate a bad response really quicker, right? We can get these bad loans to you as soon as possible now. Don't want that to happen.
Now, Bob, you make a great point. A loan should always be going forward. The expense is because it goes forward and goes back. So
exactly
that's
right.
Whether it goes back to sales or it goes to underwriting or processing. The problem is it's the back and forth, and technology should be helping us to where we're never going backwards. It's always moving forward because we validated, we've checked. If you could keep the back and forth, you'd probably, I don't have make something up, but I bet you'd say 40% on the cost of a loan, because that would reduce the time. That's what holds us back. It's going back, well, I don't quite like this. And that's where you're utilizing technology to help to validate that decision, to always keep that loan moving forward.
Yeah, I think that's a game plan. And I will say, I think it's also a very important point when we talk about scalability and being able to really get at information accurately, quickly, and not rely on people to scale with people, right? Because we'll come back up the curve. Most of us been doing it long enough that we know the volume is going to come back. And in those cases, you want to really use your human resources to focus on getting those loans to the next level, where only a person can do it. And I think that focus of work and effort also really streamlines that process and reduces cost overall.
Yeah, I mean, you guys are both spot on there when you look at the low level too. And I think of it even from a change management process as well. When you've got confidence in the data that you are ingesting, because there's so much of it that lenders are having to parse through nowadays. It's, do you have the bandwidth or the ability to make sense of that data, and then essentially be able to take it with confidence and look at different processes within your operational flow and try to address maybe one bottleneck at a time, even if it just saves you 5 minutes per loan. Being able to create a fix there, quantifying that over a month or over a year, really can equate to some time back to deploy your people and less mundane tasks too, and just think from an ROI gain. Mike Metz did a fantastic job. We connected a webinar 2 weeks ago, just talking about really being at the ground level of starting to understand how to parse through all the data that they're ingesting and look to figure out into unique bottlenecks that they can use the insights to start to solve for.
Tom, that also brings up a really good point as well. Is like, when you look at how if you can automate the capture of data throughout whatever process, this could be, any process, mortgage process, but as you're able to gather data, lots of data, our focus, a lot of people's focus has always been on just give me the data I need for my underwrite, and we'll kind of get that out, right? Because when people are doing that work, time is money. machines, can do a lot more, a lot quicker. So the other avenue to really think about is, the art of the possible. If you're capturing a lot more data through an automated process, you can use that information to do other things, right? Your data scientists can look at it to figure out maybe can I prioritize loans? Are there any data that I could use to help determine price or product? And because it becomes a wealth of knowledge that may not be relevant directly to the underwriting process, but could be very valuable to a data scientist within the organization to look for trends and use that information to do other things that will help grow the company.
Yeah, one of the things that we've done is we show and communicate it to all of our senior leadership on the bank side to really show, but those that start a process with the customer, and I know this may ruffle a little feathers because there's those traditional loan officers. No, I've got to put all this in. I need to handle this, not allow my customer to do this. There's this fear, or that's part of the selling. But when we have information where that customer, that loan officer pushes, and then that customer enters that information in, and then that loan officer utilizes the technology and has that customer where we do get to look at their bank statement or stuff like that. So we provide that information to show them, hey, these loans close 5 days faster than these, whether it's a refinance or purchase, showing them how that process. We show our processors that work with folks like that, when you utilize this, or that loan officer is utilizing this is how many more loans you're able to touch per day. And again, that's where utilizing technology to your benefit, and then making sure that you're communicating openly the success that you're seeing around it. Right. It's great when Fannie or Freddie says, hey, this is how many days you'll get, or when, ICE comes out with their data, or Black Knight. But when you actually are getting to use that and show that in your own organization, that's where I think the rubber hits the road.
Yeah, that's a great point. We've seen with some of our customers, and it makes sense when you have the borrower engaged, you've got them on the hook, and that's when you want to get the information from them. If you ask for 2 pay stubs and they send one, and you have to send an email back saying, hey, give me another pay stub, it could go days without that. So what we see the automation technology employed is really the very front of the process. Hey, we need 2 W-2s, and they have to be within 30 days of each other, or 2 pay stubs within 30 days. They upload those pay stubs. If you can immediately process that information and report back to them when they've satisfied that condition, or they haven't satisfied the condition, hey, you sent in 2 pay statements, but they're too old. Can you send me more recent ones? You have them on the hook, and then you get that information sooner. And it really, to your point, it really sort of collapses the data capture cycle. And the sooner you can get the borrower out of the critical path, the more you can focus on getting the underwrite done. So that pushing technology and automation to the very beginning of the process is value, not only from a efficiency standpoint, but also from a customer standpoint too. I don't have to look at my email. You told me right away I didn't give you what you need, and I'm going to go ahead and fix that problem right now.
Spot on, Bob. And that's what I want to direct the next question to you here. You kind of dug into a little bit in the previous response. So just a reminder to the audience too, any questions, comments you've got for Bob, Sean, myself, feel free to drop those in the chat, and we'll look to address those. But when docs to data and verification processes get to a point where they're reliably automated, with levels of accuracy and completeness that are outpacing your human performance, what, in your perspective, does that mean for business and elasticity, specifically the ability for lenders to scale with market demand?
Yeah, once again, I think that if we go back to what the market looked like a couple of years ago, where it really became a challenge to bring in people to help process loans, right? Either data entry or loan processing. And it's not a head down data entry job. You have to know a little bit about the process. So getting people trained up and it becomes, and of course the demand outweighs the supply, so cost goes up, and so you can't, there's no elasticity, and then the market goes down, and now you have a big workforce that you have to sort of contract, and it's sort of, it's not a great way to scale, right? It just, people don't scale very well. But with automation and tools, it allows you to go up and down as the market goes up and down, right? We're a very cyclical world. And so that automation allows us to do that. But it, like I said earlier in the very beginning, it all starts with having really trusted, reliable data, right? When you build in that automation to your process and you're able to streamline it, and get the data correct and put it to people when a human is needed, and humans are needed in our world still, that's when you've got efficiency, because now your human collateral is working on the stuff that they really need to work on. You remove all the other noise from their process. So now, and we've seen examples of this in the past from other clients, is now the elasticity, even on the human side of the world, has increased, because they're so focused that instead of having to grow your underwriting staff as volumes grow, it's more of a logarithmic growth. So you don't have to, it's not a 2-for-1. I get 2 loans in, I got to get 2 underwriters. And they're so focused, they're getting so much efficiency that how you have to grow that human component of your business is a slower growth with automation. And so I think that provides a lot to a company, right? It gives you that ability to scale up and down without having to have massive hirings and massive layoffs as part of it. It gives you the efficiencies that you need, and really goes to, full circle, goes back to, you really have a higher quality product at the end of the day. So that I know it's a long answer, but there's a lot more you can do with it. But that in my mind is really the key terms in terms of ROI, is elasticity and really allowing your humans to focus on what they're really good at.
Sean, anything you want to add on there? I mean, I thought Bob was pretty succinct too, and I can imagine just the relevancy of hiring, firing cycles. Bob, your point too, especially when you're paying top of the scale too, because the demand is low as well. Typically, those are then going to be the first people out the door when that demand flattens out. But I'll open up for you.
So, well, before I get into that, there's a couple of great questions in the chat here. And so I think that first question there. And
I'll verbalize it real quick in case anyone's not in front of the Zoom screen. From my anchorman brother in San Diego, Femi. In both your experiences, are there specific areas in the manufacturing process that have had an outsized ROI from improving data quality?
I'm going to say yes. We've been able to, by having better data quality and getting more acceptance on the front end, we have been able to see more files per loan, really in processing, and then less touches in underwriting. And the way that I look at it is, I'm going to give TMC, a plug here, but the benchmarking. We benchmark against the data, in our collaboratives. So just definitely, we have seen an improvement. And I'd like to throw out a question, because I love interaction. To those on the call, let's just say the market turns tomorrow. Who on this call feels more prepared that they have the ability to handle more loans than they were able to a year ago, that they know that they're more prepared and can get more loans through than they were just a year ago? I would ask everyone, what's your thoughts?
Perfect. And then while we're eliciting some feedback at the audience, I'll throw out the other question if you guys want to tackle it here from Alan.
I'll just add one more point to Femi's question. I think one of the as we said earlier, as you move further down the manufacturing process, the ROI goes up as well, because the cost of quality is a lot more critical. So you look all the way to the very end on the QC process. I think that's where you see the biggest ROI, because what's the worst that could happen if you don't QC your loans, right? And you sell them and and there's repurchases involved. So I think you see the ROI throughout the life cycle, but as it becomes more data intensive and as you have a bigger risk for error, then that's where you see the biggest ROIs. And I love your question, Sean. I'm curious to see what people answer.
It's a shy group, which makes me wonder if they're maybe not as prepared as they would like to be at the current time. So I'll allow a little bit more time for feedback on there. Other question in the chat here was from Alan and asking, are you taking any steps to capture the art portion of the data upfront, because that data also causes problems, expenses if the underwriter sees it for the first time later in the loan process?
Yeah, we are doing research on more of the unstructured parts of documentation. So if you think about appraisals and we had photographs, typically software would say, hey, you can't look at those photographs. A human has to look at those photographs, but there are computer vision techniques that can be applied to determine whether the documents have been, or the pictures, or even the documents, that matter, have been altered or adjusted or corrected. It can also, there are programs out there that can, look at the roof line and to tell you whether it needs to be replaced and things like that. So there are technologies out there. There are technologies we're researching to allow for to unlock more of that unstructured data, even comment sections, right? And areas where it's free form text, being able to pull that apart and understand the sentiment behind it and pull out the key pieces of data. That's all research that's going on. It's a little bit harder to measure that. But we are, and other folks as well are working on that. And I think we'll have a breakthrough at some point. And when we unlock that unstructured data, that's really where it becomes fun, because you're starting to delve into a little bit more of the art part. But I really think that our process is one that will always require human validation and interaction on some of those pieces that require art, right? And to your point earlier, Sean, there's always things that come right on the line that and a person can look for those mitigating factors and look for certain things that machines don't have that same ability. But we are definitely working on trying to start capturing some of that art part.
No, that's a great question, because it is an art. And again, that goes back to, for those that have day one certainty and can utilize that technology without needing the pay stubs or that stuff, that's what I don't even want there to be an art. That just takes away from us, where we don't have to worry about it because the agencies are taking it on. But no, I mean, that's a great question. There is that art, because once an underwriter sees, it can never be unseen. But I look at it at the end of the day, then, is it a loan that we should make or not make? Those are more of, I think that happens less often than we think. We hear about it a lot, but if you're to look at it over the amount of loans that you do, it's very rare that really actually happens, that underwriter is getting something that just totally throws the file off, when you put it in a percentage. But to that one customer, it's a big deal, because you think you're right the whole way. So no, it's a great question. I don't know that I have a really good answer for it.
Oh, is it? Oh, well, I'd say I've got one more question for you both. Sean, I'll start off with you on this one. And that's, will lenders that develop a much more elastic business model hold an advantage over their competitors that stick with their current practices?
Well, I mean, it's the right now, if you continue to do what you've always done, you're always going to get what you have. So I think absolutely you're going to have to continue to grow. Technology is always going to be something that we're going to be looking at. It's always going to be developing, and we're always going to have processes put in place to be able to communicate, to get it out there, to help the consumer understand. Part of the issue with technology is do you have videos, or do you have stuff that helps the consumer so that they can navigate through that process? Do you have a a technology. So for us, what we found is sometimes our customers have a hard time with sometimes the technology. So we've created a help desk, just like you have a help desk for your loan officers. We've got what we call a customer help desk that's manned until 10 o'clock at night. So, to help the customers so that they don't get frustrated and they have the ability to make contact. But I think that our ability to grow is going to be, we will see efficiencies in the technology, and those that don't utilize technology will not see their costs come down. And those that really utilize not only will be able to do more loans, have higher customer satisfaction rates, but be able to do it at less of a cost than our competitors. And that's what's going to allow those that embrace and move with change will continue to be, will really dominate the market going forward. I mean, we've seen what's happened with some of these market disruptors that have come in with some of these big companies now, but there's no reason that I won't name the name of that company in Detroit, Michigan, but they were such a disruptor. But there's no reason that we can't be as good or better than them, even as small independent or small banks.
Yeah, I think that's a great answer. The way I look at it is, we know that we're in a cyclical business, and the bottom, we may be toward the bottom, but we know it's going to come back. And to your point, Sean, like, where do you want to be, right? But the other thing is, as these companies, and there are really some forward-thinking companies out there that understand that now's the time to train and implement new technology and refine your process. You don't want to do that when you're underwater with volume. Right? It's the whole analogy of changing the tire on the car while the car is still moving. It's not a great way to go about it. So the folks that are planning to lean their process out, apply automation, customers are going to get a sort of an expectation of performance, right? They're going to get conditioned to get things more immediate. It's like buying things through Amazon. You expect it to show up overnight now. We've been conditioned to think that way. If you're not keeping up, you're falling behind. And if you can't compete on the performance and the turn times and the cost that some of these companies that are forward thinking and implementing technology, then it's going to be a pretty bad story for you. So that elasticity does more than allow you to save operational efficiencies. It really positions you strategically to move your company forward and compete in a very technology driven market.
Yeah, I mean, you both are spot on. And Sean, I loved your example, essentially where you're marrying your human capital with technology to meet the consumer where they're at and providing resources that they're going to gravitate towards. And I'm sure that pays dividends just on your app to close pull through by having those additional touch points to the consumer. And I would just add, I think the answer to the question is unequivocally yes. And just thinking of it more so from a data perspective, Bob, you brought this up at the beginning of the discussion. It all kind of falls back to the premise from a data standpoint that as you're cleaning your data and going confidence in it, you're creating a snowball effect for your organization and the potential efficiency gains. And the confidence that you have, whether it's deploying enhanced secondary market strategies or strategic planning, decision making, the products that you come out with based on some of the data reads that you can extract back to your customer base. It kind of opens Pandora's box almost as far as how you can grow and innovate.
Absolutely.
This is why it's so important to be, I think part of, the Mortgage Collaborative of really listening. You've got to, again, I'll talk about looking at your technology, your deck, but realize that there are companies at the beginning, they do really good and then things happen. So you've always got to be out there in the market looking, working with the Mortgage Collab, seeing some of those different vendors and stuff, because technology is always changing and some vendors continue to stay on top of it and others, sometimes they fall behind, and you've always got to be looking at who's the most advanced. And, if you start looking at a new piece of technology, how am I going to create that efficiency? Is it worth, as somebody asked, do I get a return on investment better than that? What's the pain going to be? Well, what am I going to be if I take this on in 2 years from now? Where is this going to take me? And it's important for those that are on this call. It's why it's important for us to discuss this, talk about it, and collaborate about this, because this is how we get better.
No, you're so spot on, Sean, and appreciate the plug there. It's part of my daily process too, in vetting in the vendor community too, is that constant reassessment of who's innovating and who's providing solutions that are going to offer the most value out to our members. What I like to see out there is from the vendor community too, there's a heightened sense of awareness now too in the due diligence and the consultation process with their clients or prospective clients on what are we doing to ensure that not only are we providing the latest and greatest technology, but that we're creating that elasticity with your integration partners and your core systems so that you can experience those gains, not only right after, the implementation and deployment, but ongoing as these companies continue to innovate.
Well said.
Awesome. Well, on that note, I know we're up on time. I really enjoyed this discussion today. I appreciate the interactivity from the audience. Bob, Sean, thank you both so much for your insights. And
Thank you.
I highly encourage the audience to, share this with your peers as well, as we send in links to some true asset resources, as well as on-demand recordings for podcast and YouTube video versions of today's discussion as well. So be on the lookout for that.
Thanks a lot, Tom. It was a pleasure.
Thank you, guys.
Thank you, guys.
Take care, Sean.
Yes. Too. Bye.